session on crypto and regulation. I tell you, when I have sessions like this, I get excited about them because although I'm deep in the space, I always love to hear the opinions of people that are living this day to day. And really the topic of this next panel for me is tremendously exciting about building a blueprint for banks in the crypto sector. I think this is in the context of banks and financial institutions increasingly having a bigger focus and look at what's happening in crypto. Historically, this has been more focused on family offices and funds that are investing in, but increasingly competition and demand from consumers and institutions is driving banks towards adopting crypto solutions. So over the next 45 minutes, we're going to take a look at what the current state of affairs is with banks and the adoption of crypto. We'll also take a look, of course, at the risks and the regulation around this, touching on topics around AML, KYC, capital liquidity, and investor protection. We'll also explore the controls that should be in place to mitigate risks and address regulatory requirements. I want to jump right into it. Boone, I'd love to start with you. First of all, please do introduce yourself, and then could you give us a brief on where are we today in terms of banking adoption? Given the evolution of the ecosystem in the recent years, has adoption aligned with expectations?
Thank you very much, Shannon, and thank you to Regulations Asia and everybody for this opportunity to share view. My name is Boone. I work in Deutsche Bank based here in Singapore, specializing in the intersection of financial services, technology, and regulations. So I'm in the custody security services of Deutsche Bank. Shannon, as a reaction to your question, I think the digital asset evolution, right, can be seen as a super cycle developing in parallel to the digitalization of our economic activities, right, of the crypto space. So, for the digital asset super cycle, we see that, there's an opportunity for decrease of traditional cost, new growth, and then at the same time as well, new wealth creation, new employment opportunities as well. Why is this a digital asset super cycle? It started with a crypto, and then within the crypto, right, there's this specialized sub ecosystem of DeFi space. So in the crypto, it has been used, like for example, as a payments medium, and then increasingly is creating this new role of a digital asset custodian. There's a cash element to the banks as well. So I'll say that from this ecosystem perspective, banks are getting it, and then banks are actually, right, the adoption is being aligned with expectation, as the banks expertise and risk management, risk appetite, right, grows in tandem. In the DeFi space, right, I think this is an open space that's still open for adoption. Banks would be very interested, but the banking industry, I reckon, will be at the awareness and assessment stage. On the tokenized asset, because of its familiarity with traditional securities, banks are also getting it, but it needs to bridge, right, into a new ways of doing things as a result of tokenization, fractionalization, and DLT interoperability, right, of securities, of funds, and then of collateral as well, and very importantly of programmability. Final part on CBDC and stablecoin is closest to e-money, and therefore again banks gets it, but again banks needs to bridge into the new ways of doing things. For example, right, PVP with a digital asset, and then what does it mean when a single platform could actually do, right, a atomic settlement? I'll stop here. Thank you.
That's great, Boone, and that's great to set the stage. You've covered so many of the topics that we're going to be talking about today. Arvi, I want to come over to you. I mean, that idea of a super cycle, I really like the way of that kind of looking at the adoption curve. What have you been seeing from the banks? Does what Boone had indicated, does that resonate with you? And please do give us a brief intro as well.
Yeah, good afternoon, everyone. So I'm Arvi De Vera. I'm for 12 years a proud union banker, having led a lot of our work in the last 6 years in fintech, blockchain, and open finance. I now take on a new role as CEO and co-founder of Union Digital. And in that role, in building this digital bank or this digital asset native bank, a lot of these topics are very relevant. And I go back to our history. When you talk about adoption, what comes to mind is how we created the blockchain platforms, or we use this technology in the Philippine banking setting to create the use cases, because adoption is always a huge risk. And if you're trying to do retail adoption, it's obviously very challenging. What we found early on when we started building blockchain solutions, starting with our I2I platform in 2017, was we could use this technology for communities among untrusting parties and individuals. And in the rural bank setting, it was very applicable because these rural banks had no access to a local ACH and no access to each other. So by creating a blockchain platform with Union Bank as the master node, we were able to enable this platform and this interoperability. Now, fast forward, obviously within that platform, we had our stable coin, which was PHX. That's Banco Central approved and regulated to use as the token within that network, right? We took that a little further when we did the first cross-border blockchain remittance transaction with OCBC in 2018. So we did a bank account in Singapore, cross-border remittance to a bank account in Surigao del Sur. And that was where it was very telling because we completed that at atomic settlement level in 3 to 4 minutes, from a bank account in Singapore to a bank account in the Philippines. And I think that opens up the discussion to the many use cases there. No? But I think I'll just end by saying that adoption in the Philippines has been challenging because of the use cases. So when we started, it was really about finding the use cases or the gaps within the current systems. And it might not be retail, it might be B2B2C, like our rural bank platform. Now, though, you're seeing a lot of adoption because of the play-to-earn community and the growth in cryptocurrencies driven by the play-to-earn community. So
and
that's also...
That's a great point. I mean, that demand that we're seeing, I mean, that's very unique in the Philippines and Southeast Asia around that. Sebastian, I want to come to you. I think, you know, a lot of what RV was talking about was the use cases, and that points to obviously the demand in the community. I mean, what do you see as the key drivers in demand on this? Is it just retail private wealth, or are you starting to see more institutional demand, more mass retail demand? And then how are banks integrating these systems?
Definitely. Hi, everyone. So Sebastian Whitman, Head of Strategy at Komaino. Komaino is a regulated digital asset custody solution built by institutions for institutions. And it was launched in the form of a joint venture in 2018 between Nomura and the Global Investment Bank, Ledger, a French technology provider, as well as CoinShares, a leading digital asset fund manager. And back then at Nomura, we looked at digital assets much bigger as opposed to crypto. There was obviously the last bull market, but we also looked at the potential of tokenization and really the underlying potential of this technology to really restructure the overall financial services industry. Back then, banks were really not looking at crypto as a potential asset class. It was more looking at the potential of digital asset, but we saw a lot of retail interest. Obviously, it was the last bull market. We saw the Bitcoin price going up to 20,000. And so banks also started to look at the potential of Bitcoin becoming a bigger asset and also gaining institutional interest. So we noticed that the infrastructure at the time wasn't there, but education across the asset class evolved. There was more regulatory oversight, and we started to see initial standards being adopted. I think the demand still was driven by retail. It's a phenomenon where in digital assets and the overall ecosystem, most of the innovation comes from the retail sector and then moves into the institutional sector once its regulation is established, as well as infrastructure. So I think it's been very interesting to see the shift. And Bitcoin is then being moved from a currency to potentially becoming more like digital gold, with a number of corporates adopting it as part of their corporate treasuries. Then we see the advent of stable coins coming to market, which reached over 100 billion in cumulative value across the COVID pandemic. And so we started seeing different factors and different types of financial products being supported by digital assets. And so we see really the industry growing. And especially over the past year with the advent of NFT and discussions around Web3, really saw a new wave of participation from more traditional corporates that now are looking at their own Web3 strategy. Ultimately, everyone knows that a lot of these ecosystems will be based on distributed ledger technology, which most likely will all run on the similar protocols with the similar key requirements. And so the demand factor is not only as a financial sector, but it's really as a change of the overall economy and digitalization of this. So we really see demand from a number of areas, on one side from the financial sector, as well as the corporate and retail sector, and continuing to do so.
That's great, Sebastian. Alex, I want to come to you on this. I mean, obviously, adopting crypto is not easy. You know, just even as a retail, you know, you have to download a wallet, you have to sign up on these platforms. When you look at banks and their crypto adoption, where are the pain points coming from? Is it compliance, financial crime, operational risk profiles?
Yeah, it's interesting. Hi, everyone. I'm Alex Pillow. I'm part of Moody's Analytics. That's the non-ratings agency part of Moody's, and specifically, I live within the KYC unit here. So, compliance, financial crime, risk profile, all those things are intertwined, right? Sometimes people have a generalist department. Sometimes people have silos, but none of them mean anything unless you operationalize them. So, it's all together. The biggest pain point that we've seen, that I'm seeing in sort of conversations with customers, and also the crypto customers that we serve, as well as the traditional banks, is competence and confidence. A lot of the people that are leading these departments, whether that be compliance operations or onboarding or risk management, when they were coming up, this wasn't a thing that they had to worry about. So there's a lot of sort of having to go backwards to, take a step back to go 2 steps forwards. And really the only way that's going to get closed is a lot of investment, whether that's bringing outside people in who really know this stuff, or whether it's a lot of training and a lot of help, and, have you got the right vendors? The challenge again is that it's kind of a catch-22. How can you pick the right expertise if you don't have any yourself to judge by? So as you say, it's not easy. The problem with that gap, the pain point it causes, is you go, okay, I don't know what I'm doing. So you take a safety first approach and you say, right, we're not going to deal with crypto. And, that leads to other issues. You're not getting any of the alpha that's available. You're not actually helping the industry grow. You're potentially going to be left behind by competitors that do get on board. So, what we'd like to see is people take the existing skills they have across KYC and AML and financial crime control and risk operations. And it's taking that and asking the right questions, because ultimately you can bring it back to use case. Don't worry about the fact that it's a cryptocurrency. Worry about the fact that it's a currency. Don't worry about the fact that it's a crypto security, or whatever term you prefer. Worry about the fact that it could be treated as security. So who's this customer? Do you know that? Are they real? Are they who they say they are? Are there any known risk indicators? What is their forecast in terms of their business? Does their behavior match the forecast? Are the transactions, are they making sense? Do you know their source of funds? Do you know their source of wealth? Yeah. They're not new questions. It's just people need to be confident in their ability to ask them and then know where they're going to go and get those answers. So, I think as that competence gap closes, people will become more confident, and then hopefully some of the pain will go away with that.
Yeah, I love the competence and confidence. I think so certain banks might struggle with that with traditional assets, much less digital assets. Boon, I want to come back to you. I mean, if we take a look at what are the assets that we're talking about here? Are we talking strictly about Bitcoin and Ethereum? We're looking at stable coins, settlement coins, and what does DB or what does DB find exciting in this space?
Yeah, Zenon, I will answer in a more generic way.
Okay.
I think, when banks are talking about crypto, I think the focus is really what this Regulation Asia topics have been really all about: regulations, license, risks, AML, KYC, prudential treatment, expertise, and know your coin. But, if we actually split down the coin between utility coin and cryptos, right, let's just take these two broad lenses. Utility coin and let's say the underlying DLT, it actually represents the opportunity for banking industry to reap new efficiency, new operating model, and increase existing competitiveness. Today's financial market structure is really based on the 1970s Wall Street crisis, whereby you started automating a sequential flow of things. And therefore, today in the financial industry and in the cross-border space, there's a number of intermediaries involved in a sequential way that everybody's actually doing the same thing on a same activity. And this is actually creating a lot of redundancy. DLT, the underlying technology to crypto, can actually help solve this in very big ways. Let's talk about utility coin. Utility coin can be really interesting from a tokenomics or behavioral economics perspective. So, for example, there's a fish coin that's right now rewarding participants in the seafood supply chain space, for them to actually enter information that will support the collation of sustainability of a seafood going to ESG, by using this utility coin that actually rewards such behavior and incentivizes such behavior. There's another coin called Moss coin that is essentially a carbon credit offset coin that with it, it actually allows potentially banks who are into, or financial institutions are into creating funds, right, to have a Bitcoin, and then if you want to have energy offset, right, you actually include a Moss coin that is a carbon credit offset coin into the same fund, and maybe that could qualify as a more eco-friendly Bitcoin fund. So that's on the one side, right, the utility coin. On the crypto, it's really to your point, right? The more liquid, the more established one, the more understood ones, the ones that with the greatest, right, risk assessment and risk understanding. So Bitcoin, Litecoin, Ethereum, and some others. However, right, from the opportunity perspective, and I'll very quickly go through this, right. There's a direct exposure, which is really the opportunity for the banking institution right now. So cash accounts to VAS, for example. There's the digital asset custodian, safekeeping on behalf of clients. But at the same time, right, the potential opportunity to deepen into this value chain, for example, in staking, borrowing, lending, right? And then putting aside that as well, there's also the execution part and the trading part, the funds creation part, and the rise of the new crypto hedge fund and new crypto asset managers to service. All these are actually new opportunity, of course, bearing in mind the new risk and the new cost as well. Finally, to broaden to the adjacent value segments, there are other opportunities, like for example, in tokenization, transfer agency, or in the role of crypto fund administrator that will play important roles in investor engagement and in ensuring, right, best execution and MIS reporting. So I think when banks talk about crypto, it's not just talking about the coins, but it's also talking about whether are there new roles or are there existing roles that could change, and importantly in the DeFi space, right, the deep potential that it could actually inspire evolutions in the way traditional finance is being done, for example, in liquidity management and market making. I'll stop there.
Those are some great examples. I mean, RV, I want to come back to you. I mean, Boon had talked through some of the examples there, and I mean, you guys are living it, right? I mean, you're obviously a digital first bank. You've launched your own token. I believe you're thinking about a stablecoin. Can you talk about, I mean, what was the objective of launching the token, and why did you do it? And then looking at the kind of the stablecoin offering, why now? Can you talk a little bit more about that, RV?
Sure. And Boon, thank you very much for explaining that technically, both sides, the security side and then the asset side. That's fantastic explanation. I'll jump off that because the first part of Boon's explanation was the fact that you can with these tokens you can actually have smart contracts, smart money, and that's really been the challenge, right? We've been dealing with I call it dumb fiat for the longest time, and the painful use cases there were when you send a cross-border transaction, you have to wait for confirmation. You're not sure if they've gotten it. You're not sure if that's been tokenized. So all of those issues cannot be programmed into the token, right? And that's where the inefficiencies and the challenges are, and risks increase. So we actually saw it as an infrastructure DLT technology capability that could address the dumb fiat problem, the problems we were having in the fiat world about reconciliation, about settlement. And that's what we took into our rural bank I2I platform and then expanded to other players where you have atomic settlement, you have clarity in terms of KYC, in terms of audit. And that becomes actually much better for the regulators. It actually de-risks the transactions, which has been fantastic in the rural bank setting. We now have rural banks that are connected to the local ACH through this network and can transact both ways precisely because they've been validated, they've been verified, their transactions, and all within the powers of what DLT can do, which blockchain is really governance by design. And we saw that as an opportunity, be it in stablecoin, be it in this platform that we're doing, really as a way to be smarter and more efficient about how we program money, how we audit, track, report to the BSP, and all of those efficiencies also translate into a better customer experience. because now the rural bank doesn't have to go through his correspondent banking relationship for 5 to 10 days. Right now, we can do it in 3 to 4 minutes. So all of those inefficiencies and risks are actually addressed by blockchain as well. Now, you still have counterparty risk, of course. You still have settlement risk. They've just transferred to a different technology platform. And our job as bankers is really to understand those new risks, really, and recontextualize them with this new technology. So I'm excited when we talk about chain analysis, we talk about understanding wallets, because from our point of view, adoption is being driven by the customer. And in the Philippines, the play-to-earn community is a customer we cannot ignore. And they are driving digital adoption, digital currency adoption in their context. They have specific AML, KYC challenges that need to be addressed. Obviously, the nature of those transactions come from the crypto world, not the physical world. So you have to address the provenance of those transactions. But those are all challenges I think we banks are built to address as regulated entities.
I mean, most banks are, but one could argue, you guys are a digital first bank, right? And I'm curious, how has the fact that you are a digital first bank impacted kind of the appetite for risk and considerations when it comes to issues like financial crime? I mean, do you think that's given you an advantage, both in terms of getting the regulatory approval and in day-to-day operations?
Yes, very much so, because the more digital we get, we know that the digital risks will also increase. It's just about increasing your capability. So very early on, we acknowledge that we need to really have a lot of expertise around cybersecurity, around financial crimes, around all of those risks. So early on, we beefed up on that. So I think it was Alex who spoke about confidence, right? And a lot of our confidence comes from being early. I wouldn't say only early adopters. We got our hands dirty 5-6 years ago, experimenting on Solidity, building on ERC20, with Consensus, Microsoft. It was all discovery. And this is education you get over time, where as an institution, you build your confidence because you create the proper structures to internalize this new level of risk. You can't, I think one of the learnings there is you can't teach the old legacy infrastructure and process the new ways. You really have to think about maybe having a parallel team, a digital risk team coming alongside and really processing all these new risks, because they are new risks. It's very hard to force fit the old into the new. It's like, and then, I'm very thankful we have a digital bank license, because for the longest time, it was about force fitting that into a universal bank, which is very challenging. We've done a lot of great things, but it's not without its challenges. And now that we have a separate digital bank license, it makes it much easier to execute. But definitely, it's a challenge for traditional banks. It requires a mindset change and really structural changes to institutionalize that confidence and technology.
That's great. Alex, I mean, RV seems both competent and confident. What's your assessment? Do you think they get an A+ for their efforts? I want you not on this public forum to rate how Union Digital is doing, but I do want to come to you. I mean, we've seen, I guess it was just over a week ago, we saw the phenomenal money launderers that were trying to move billions of dollars worth of crypto. And the government found it, and RV mentioned chain analysis. I mean, we have these tools now increasingly that the original narrative was that this was very anonymous, but what it's turning out is, we're still searching today for those, the specific North Korean hackers that took away all the National Bank of Bangladesh's money. But we found these hackers very quickly who took, who was laundering the money that came out of Bitfinex. And why has financial crime been the focus?
Yeah, it's a really good question. I think it's not about financial crime being the focus on crypto, though. I think it's financial crime is in focus generally. So you mentioned the Bitfinex asset recovery, which is fantastic. But if you think about other things that have been going on in the financial crime, well, we just had the Swiss secrets leak over the weekend. There is a lot of scrutiny, and it's been building for a long time, but particularly with the current political climate of how much dirty money is in London, my home city. So I don't think it's necessarily just on crypto, although if you're in crypto, maybe it feels like that because that's what you're living and breathing. I think financial crime is in focus generally, as it should be, because there's a lot going on. I think you made the good point that with the Bitfinex example, if you are going to do some crime and you want to hide it, the blockchain is a terrible place to try and hide what you've done. I have come to start saying that, blockchain is a forensic accountant's dream. So you've got all these people who are going to be really excited about the work they can do, which is great. And there are tools like Arvi mentioned, Chainalysis, Elliptic, I'm a big fan of. There's a number of other players entering that market as well who can help you do that if you're not a, crypto original with a huge amount of accounting knowledge. I think why it may sometimes feel, crypto equals criminal in some people's minds. And I saw a stat the other day, I think it's on an article from Binance, where they said, look, only 2% of the world's population have any interest in crypto. So this is for the 98%. This is why they drive the narrative, because there's such a big majority that aren't really sure what it is that only a few times has crypto grabbed mainstream attention. And unfortunately, for everyone that wants this sector to do well, one of the early ones was the Silk Road. I know it's kind of old news for us, but it's still there. It still lingers in people who haven't engaged in the sector that, oh, right, that's what it's used for. So we've got to remember that whilst, the transaction audit trail is fantastic, people have got that sort of tar, they've seen the tar from that brush. And there are also genuinely some benefits to a criminal that wants to use crypto. There is the gap in expertise. They are often several steps ahead of the people that are trying to fight against them, whether that be practitioners in private sector or law enforcement or public sector regulators. There's the ease of moving and accessing funds. It's a lot easier to do that than move, crates of cash around like you saw in Narcos, if you watch that series. And there's not an anonymity, but there's pseudonymity. So if you can get a wallet and conduct transactions with a firm that isn't ever going to KYC you properly, then you can wear a mask up to a certain point. Someone might see what you're doing, but they know who's behind it, and then you get stuck into those law enforcement challenges. So I think all of those things mean there's a pull factor. There are some great tools we have to fight back, but I think that's some of the reasons, at least. I'm happy to hear anyone else's opinion, but I think those are some of the reasons why it is a focus and why we need to get it right, because otherwise the sector won't flourish if there's always that connotation.
Yeah. When one of my colleagues, when they saw the picture of the bust in the U.S. Marshal sitting around the table, and they said the next season of Narcos is really going to suck, because instead of drug money, it's just going to be a USB stick on the table, and instead of shootouts, it's just going to be people
not quite the same dramatic delivery.
Yeah,
is that?
Yeah. Well, you lose on one side, you gain on the other. Sebastian, I want to come to you. I want to talk about operational side of things for a second. I mean, the operational risk, when you look from a bank's perspective, how have the frameworks for operational risk changed as banks have needed to adapt to expand into crypto-related services? And if you can talk a little bit about the flexibility of those operational frameworks.
Yeah, no, definitely. So I think to understand this, obviously, digital assets are bearer assets registered on a blockchain and then secured by a cryptography in the form of a public and a private key. So that itself has never been the case in financial products. Most of these has been registered in the security houses or central security depositories. So it really creates a new set of complexities from an operational perspective in terms of how to move assets in a secure manner from one wallet to another. What's the segregation of duties in a global organization? How do you do that in a 24/7 global space, as well as then what is the reporting? There's hundreds of decimals in digital assets which haven't been found in the existing financial services industry. And so it really creates a number of complexities which can't be solved. With Komainu, when we launched it in 2018, we really worked very closely with Nomura to leverage their existing frameworks to make sure that we can institutionalize the digital asset class. So we looked, for example, as the provenance of funds and the KYC onboarding requirement. We wanted to keep it as stringent as a traditional bank is used to ensure that future customers will be accustomed to the onboarding framework and they would be trusting Komainu to do so, as well as adding new elements around source of funds, looking at anything around KYT, where has this asset come from, which has been present in digital assets but not in the traditional world. And so it's really adapting and making the digital asset ecosystem as similar as possible to potentially FX, whilst also ensuring that we adapt to new business models and new business cases. And that is a new decentralized world with a number of new business cases. So we've really been looking to create a flexible approach whilst ensuring that we have the institutional pedigree and frameworks in place to really, on one side, comfort educators, and try to make it similar and institutionalize as an overall asset class.
Yeah, I guess having the input of Nomura there in the beginning probably helped quite a bit to make sure that you were building horses for courses in terms of products that you were bringing to market. Boon, I want to come over to you. I mean, recently we had the BCBS consultation, which really proposed a very conservative approach to the treatment of crypto assets on a bank's balance sheet. How would this, from a bank's perspective, impact or shape a bank's approach to kind of building out crypto-related services and offerings? That is something that Brad talked about in the previous session. How would that affect things in your mind?
Thanks, Shannon. So we'll note that the consultation that was issued last year, right? Well, the recommendation is not out yet, so I think they are still in the process of deliberation. But essentially, right, I think the consultation split the crypto world, or the digital asset world, into three big buckets, right? Group 1A, which is tokenized asset; Group 1B, which is stablecoin; and Group 2, which are everything else. So, for example, the crypto. Just a very quick word on stablecoin. Stablecoin, right, or if I can abstract it to a digital currency, it's really important in the growing digitalization of economy, because we need a capable digital mean that encapsulates trust, right? So, Union Bank's stablecoin encapsulates trust in order to facilitate digital exchange of value. So, from this angle, the BCBS consultation and its proposal, right, to Brad's point, it has elicited responses from the global group of industry associations that fed back to this consultation. Now, essentially, right, the implications that there will be, it proposes higher capital charges for crypto, and then there will be increased operational costs and charges in terms of monitoring and reporting related to stablecoin and tokenized asset. And then, this could actually impact the bank's either trading books if you're into execution and holding inventory, or banking books if you're providing a transaction banking type of activities like payments or custody, right? So as it stands today, these are very broad implications. First, at the extreme end, it could preclude bank from participating either the execution part or the banking activities part, or one or the other. Secondly, banks could actually still participate on the assumption that clients would actually be willing to accept the higher charges in exchange for the safety and soundness of banks, right? That would be doing these activities. The third scenario, banks create a subsidiary that will be licensed as a VAS in order, right, to conduct these activities. And of course, this depends on the jurisdiction and then how this will be consolidated from a balance sheet perspective and etc. Right, but then, right, this goes on a very important assumption that the same capital charges will not be applied to the VAS that is conducting the same activities. However, there's also this principle that says, right, same activity, same risk, same approach, right? And therefore, what does this actually then mean if, for example, BCBS proposal doesn't change from its current stance, and a VAS, right, not a bank, a VAS is actually doing execution activities, will they also be required to hold 100% of balance sheet for every dollar of exposure they have to crypto, Group 2? So, that's the third potential. The fourth one, of course, for a bank is, you invest strategically in partnership with a VAS, so that, it combines best of both worlds in order to deliver the services to the new economy. Very importantly, actually, to answer this so what, right? Will institution flows from funds, from asset owners, right? Will they still flow without banks, or will they still flow with only two banks that is participating and intermediating this, such that, there's today the traditional asset, the alternative asset. There is this digital asset class that is in the midst of being created. Will this fulfill its potential, or will this, right, take another turn? Because, right, there are no banks essentially participating in this field. So I think the jury is still out. I'll encourage everybody to take a look at the joint association letter that was issued September of last year. GFMA, ASIFMA, IIF, and a lot of other leading industry associations that went into a very good analysis of these implications. I'll stop here.
That's really good. All right, I mean, Arvi, from Union Digital Bank's perspective, do all of those points that Boone put out very completely, do those resonate? Do you have a different view from the Union Digital Bank perspective?
No, again, Boone, thanks for really outlining it fantastically. I agree with all those points. That's a huge spectrum, which he definitely covered. I think all of it. But sticking close to the stablecoin part, now the challenges there alone. Definitely, I think I like the statement around trust, Boone. I agree very much that at the fundamental level, what is this stablecoin backing and backed by, right? And in our case, this is backed by a single or every peso you have in a Union Digital account, backed by Union Digital, and the asset is 1 peso, right? Peg. That level of trust at the foundational level is important, and then you establish the use case on top of that. But again, I think that's Boone covered a whole range. That's not without its challenges from a local regulatory standpoint. How you manage that against reserve requirements, against e-money requirements, is it 100% covered? Not. Those are all challenges that need to be covered as well. And then when you open it up for international settlement, for cross-border remittance, right? I see that's going to be another layer that's going to be very complicated. But Boone, I guess to your point on that, the way we've seen that kind of evolve is the way we did it with OCBC, for example, and MAS in 2018. It has to be, I think, first, again, to maintain the trust, it has to be in a way, I know it's not completely decentralized, but it has to be bilateral in a way, right? So you establish a relationship with, for example, OCBC, then you say account to account, and then in the middle, actually totally invisible to the user, you're settling in CBDC or some sort of digital token, right? But the user experience is achieved regardless of whether they understand the technology or not. I think those are the baby steps that have to happen, not just within certain countries, but in certain regulatory corridors to really allow for more use case. I don't think we're going to turn on all of a sudden and we're accepted worldwide. I think you're going to see small corridors of executions slowly scaling up to really address a lot of those problems that Boone covered. All of those challenges.
I completely agree with Avi as well. There's a huge financial inclusion and financial activity perspective in stablecoin. We'll just go back right to the days whereby Bitcoin was still Bitcoin, but it sparked a revolution in cross-border remittance when it was able, when overseas workers were able to transmit value that was completely remitted in 10 minutes, and the cost is actually free because it was priced on the the size of the data, and the payment provider took a spread versus at that time traditional banks that took 5 days to remit and then charges a lot more for this small value remittance. So there's a huge financial inclusion angle to this, that I think is slowly being drowned out sometimes, I think, by the need to ensure safety and soundness. But it's there, and I think we need to encourage how it grows. And I think Avi has just said give us some starting points. Thanks.
Yeah, I think those. I mean, that would be a great couple of questions around CBDCs as well, because I think when we look at my wife just came back from the Beijing Olympics, so she was able to try out the eCNY, and we have somewhere, I have one of the cards sitting here, and that element of financial inclusion that enables, it's kind of one step beyond what China has already done with some of the digital apps. And then going to Arvi's point on the cross-border side of things, I mean, there's so many open questions on that and how China in particular is going to handle that cross-border element of things. I want to kind of come back to practicalities and what we're seeing in the market. I want to come back to you, Alex. Recently we've just seen Singapore crack down on crypto advertising, as have the UK, Spain, Thailand, and other markets, under the auspices of retail investor protection. Filed under the accredited investor protections, I guess, as well. Yeah. Hong Kong only open to professional investors. I mean, is this a trend we're going to see going forward in the future from regulators? Because it seems like banning crypto in Singapore is not something that needs a parliamentary vote. It's something that you can execute very quickly. So it almost seems like these are stopgaps to whilst the regulators kind of work out what their long-term position is. I mean, do you think that's the case? And is this part of a trend that we're going to see going forward?
Really hard to say. Obviously, the regulators tend not to tell us what's going on behind their walls and behind their doors. We see the guidance when everyone else does. Maybe there's something in that in terms of it's a break for now so that people can catch up and they can try and get, decide what they want to do. Trend wise, I would expect it, just personal perspective, I would expect it to eventually be relaxed. If people want something, there'll eventually be enough demand, and then, they can't just hold it back. People will find ways around it. If you outright ban things, you often, and there's demand, you just drive them underground and then you have no control. I don't know if I have much more to say on it than that. I'd look at those fundamental principles of human nature and go off that, because until they put out official guidance and say, here's what we're doing now, but here's the milestones and here's where we'd like to get to, then we're all sort of just speculating.
Yeah. Like I said, for your home city, banning Christmas parties, people will find ways around Christmas parties and get to have them. Sebastian, I want to come to you. I mean, do you have a speculation on the future of that kind of element around regulation?
Regulation itself, I think it's been a very interesting journey to see. Since 2017, I think regulators have been active in the space. Obviously, there was a big bull market and then crash. So I think there's been definitely exposure in terms of the educative space to really learn what are the market infrastructure, who are the right providers, what are their operational frameworks, to see how can we regulate crypto as an asset class, but then also over the longer term, how can we regulate stable coins, security tokens, and anything that will be transacted on a distributed ledger. So it's been very interesting to see that evolution and education. I think regulators have been doing a good job overall. We see very proactive stances in countries like Switzerland as well as Singapore. And I think that will just accelerate over the coming year as adopting digital assets in a secure and regulated way will also foster a lot of inbound investments and also innovation in given countries. And so see it as a competitive advantage for regulators to really attract investment and new talent for this new wave of adoption. So it's been definitely good. I think there's still some challenges around education. If you just take Bitcoin as an asset class, it's very different to potentially utility tokens or stable coins, etc. So it's different. It's difficult to classify these and put them all under one bucket. And as we know, regulation, once it's established, it's hard to run back on. And so regulators have to have this comfort and balance between being innovative and being fast, whilst also ensuring that the regulation is fit for purpose over the coming decades. So I think it's been an interesting exercise. We've been always very open to dialogue with various regulators across the globe. We're continuing to look forward to do so in the future to really ensure that we have the right balance of where the digital asset industry is today versus where we think it's going to go in the next 5 years, and finding the right balance to enable that leg of innovation in a regulated way.
Yeah, that's a great point. I think one of the more entertaining aspects of this is watching the gray-haired senators in the U.S. understand the difference between Dogecoin and Bitcoin as they look at this, which has been interesting and an indication of how some people struggle to grasp around this, especially regulators. We've got about 5 minutes left. I just want to spend the last bit of time talking about the future. Boon, when we come back to Crypto Regulation Asia Summit 2023, what is this conversation going to be about? What will have changed? Give us your 30-second view on what will have changed over the next year.
We'll know the final form of the BCBS consultation paper, hopefully by then. But I think that's my quick view. All right, and that's the most important one because there are two things that really changes the shape of our industry in very non-visible way. One is technology, and then one is regulation. So I'll just say that regulation and technology, tends to be least underappreciated in the effect of this regulation and technology tends to be least appreciated in the longer run. So I will keep an eye out for technology innovation and maturity at the same time as well, regulation evolution that will actually shape adoption. So thank you.
Great. RV, slightly different question for you. I mean, the Philippines has been at the center of a lot of the kind of advancement and interest around this, as have other countries around Southeast Asia. I mean, what are you excited about over the next year? Where do you think the true innovation and adoption of crypto is going to be within the banking space in 2022 going into next year?
Well, for the Philippines in particular, I'm very excited about the growth of this technology, both on the cryptocurrency side and really use of DLT and blockchain. We've been talking about this for 5-6 years, and the pandemic had happened and really accelerated a lot of the use cases. So I'm excited because there's going to be more adoption, because the Philippines is really at the center, being, I believe, according to the Financial Times, the 4th largest digital growing economy in the world. And at the center of all this is, NFT usage because of play to earn gaming, cryptocurrency because that's the form of payment. And again, that's what's exciting there, Jenna, is that that's embedded banking, right? It's totally invisible to them. They don't even know that NFT is an ERC20 token of some sort. They just know it's a cute little Axie, right? But that kind of adoption is going to be exponential in growth. And I'm excited about that because that's coming finally. And then you have regulation, which will really help the adoption. I think we need the regulation to ease the adoption. So I'm excited about that because now we have use cases to really regulate, and that will really increase adoption.
That's great, and you amazed me. I mean, we got through 45 minutes of this almost without saying NFTs, but thankfully you only brought them up at the end, and so we don't have to discuss them for this panel. Alex, coming to you, maybe talk specifically about financial crime and what we might expect. 30 seconds in the next year.
Yeah. With time constraints, I'll sort of keep it simple that you should do the things you should always have done. You should know your customer, you should know your coin, you should know the wallet, and you should know the behavior. If you do those 4 things well, and if you need recommendations of tools, just DM me, then you're going to be most of the way there. Can't go much deeper in the time allowed, but I have to have a conversation offline with anyone interested.
Yeah, and I liked your point about not stealing from the blockchain. A friend reminded me it's like robbing the donut shop across the street from the police station. It's probably not a smart idea. Sebastian, just last point from you. Your thoughts over the next year. What are you excited about?
Yeah, I think one big gap is regulated cash on ledger. So to date, we've seen a huge adoption of stable coins, but these still have had their counterparty risk, underlying risk. So you see countries like China developing their own version and banning public versions, whereas I think more Western states will have to find a balance between private innovation as well as public sector adoption and CBDCs. So I think once we see more stringent regulation around this, it will really enable the next wave of adoption in the Web3 space as well as digital asset industry overall.
That's great. Perfect way to tie it off. Sebastian, Arvi, Alex, Boone, thank you so much for your time. This has been great. I've learned a lot, which is always a good sign from any panel, but thank you so much for your time.